Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Private Placement Perspective series where we're talking about investing into equity securities and direct private investing and really the world of venture capital and private equity. With me on the line today is none other than Rob Majteles. I hope I said his name correctly. He's from Treehouse Capital. Rob, welcome to the show.
Thank you so much. You said it perfectly, and I look forward to being cracking with you.
Oh, yeah. Cool. Awesome, man. Well, look, it's great to have you here, Rob. You've obviously been in the space for some time. You're a 3-time CEO. You're an active board member. You're doing quite a few things in the space. So it's great to have you here. Rob, for our viewers around the world who potentially haven't heard or know anything about you and kind of like what you're up to, why don't you give us the elevator pitch about Treehouse Capital and, like, how did you get involved in the space?
Sure, and I'll try to do it in ways that are useful to you and your audience. Let me know if I do. So Treehouse Capital is a personal investment vehicle. I launched it a little over 20 years ago. Prior to that, I ran 3 companies. I was fortunate to be successful with 2 of them. That's what gave me the capital base to go forward. I decided to work on the investing side for a variety of reasons: professional, personal, strategic, the whole gamut. And from the beginning and still today, I create deal flow, context, and learning as an investor by first trying to add value as a board member or fund advisor. And I've been on many boards, private and public. Through that, I've become a fund advisor, venture funds, and hedge funds in sort of a wide array of experiences. I'm currently a board member in residence at Mach49, a growth incubator for the Fortune 500. And I'm also a senior advisor, climate and sustainability, for a UK-based fund called Gluon.
Interesting. So, climate-based fund called Gluon. Talk to me a bit about that.
Sure, and I'll let the Gluon team describe their own fund, but I am very much focused on climate and sustainability going forward. I am a Clean Tech 1.0 survivor and massively rejuvenated by things I'm seeing and learning now. I've decided to focus the next third of my professional life to climate and sustainability. And so Mach49, where I get to do incredible growth initiatives with large companies in this area, is vital to me. Gluon, as an investor in climate and sustainability initiatives, vital to me. And from my ability to help those firms, those people, I get my investment perspective, deal flow, and context for me at Treehouse Capital.
So over the years, Rob, can you give us a bit of an overview in terms of like your investment activity, like how many investments have you made to date, and what's a typical check size look like for you, or an investment sort of range?
Yeah, so it's varied. So let's break it into buckets. Over the long span, half private, half public I didn't have it sounds like I had a strategy, just how it worked out. But so on the private side, anything from raw startup to later stage private, my check sizes there have been in the tens of thousands to the hundreds of thousands, depending on the circumstance. Through that, I found my way to become an active and investor in funds. One of the fund commitments I'm most proud of is I'm a fairly reasonably sized investor in Backstage Capital, a terrific fund focused on venture capital opportunities led by underrepresented founders, an extremely important area for impact and opportunity. And then on the public side, the checks can be a little bigger because the liquidity is a little, more managed. In every case, my investment flow came to me through board seats and funds with whom I was working closely.
That's very interesting. I found that a lot. I know quite a few investors, venture capital firms and so forth, really all through the show. And I've found that comes across that last point really frequently, in the sense of it's if you're a startup and you try and email Rob and you go, hey Rob, I know you do a lot of investing through Backstage Capital and so on and so forth, and I've got a really great idea. I'm looking to raise some cash. The probability of you responding, or the average, maybe not you, but the average investor that fits your profile, is highly unlikely to actually respond unless you have a really amazing way to articulate what you're doing in a succinct fashion. And what I've learned through my conversations with investors is literally what you said, which is most of our deal flow comes through the network. So if Matt Brown refers that same guy to you, and I have that, and you know who I'm about, you're more likely to look at that investment opportunity than not.
Yeah. Well, certainly, warm contacts better than cold. Just for clarity for your listeners, you also have to understand where you fit in the ecosystem and be self-aware. So number one, I'm working on it, but I don't have the kind of personal capital that makes people must see me. There are people who do that, and I'm trying to get there. And so I've always had to earn my way to the right opportunities. Number two, I'm a coward, and as an investor, things terrify me. I get my courage from the people I know. And so we mentioned Backstage, but for many years, I was an operating partner or advisory partner to a great venture firm called Oak, very large scale, wonderful things. They're so expert at domain identification and expertise and understanding the pitch and the people they see and how ecosystems come together. It was just glorious for me to be a part of the family, adding value as an advisory guy. And then when I'm adding value or on a board, you can always squeeze yourself in as an individual investor because you're in the family. For me personally, I try to respond to everybody, but I've never taken it upon myself to be a lead individual investor outside of a network of knowledge and understanding I have. I don't have that capital, and I also didn't have that expertise, certainly when I started, and maybe only around now after 20 years, I feel like I could do some of those things.
Yeah.
Hope that was helpful, Matt. I probably over responded to your observation there.
No, not at all. Not at all. So talk to us about the stages of startups or issuers you're looking to engage in. Must they be revenue generating? Do they have to be in climate or renewable energy, for instance?
Yeah.
Walk us through who fits your profile.
Yeah. Well, I take it as a compliment. You think I have a profile, so that's good. When you invest your own money, being eclectic isn't an insult because your limited partner meetings are short. So I love worthy people doing interesting things. And so I don't have a filter that will cut a lot of people out, other than I really need to see them through the funds and boards I know well. Now, when it comes to my focus now on climate sustainability, I do have a perspective that I think can be emboldening. So I look for people doing interesting things there. And so, I'll look at most everything. I just don't want you listeners or anybody else to be frustrated in me. I'm not a great cold contact in any category. Probably respond more to climate and sustainability innovations now than other categories. But I just want to make sure I'm careful to your listeners and not mislead anyone. However, I am a great call because my first goal is to help entrepreneurs, period. I know what it's like to need money, to ask for it. There's reasons why I'm an ex-CEO, 20 years in recovery, as I tell people, and one of us had to ask for money. So I always want to be helpful to entrepreneurs. And whether that then turns into something that helps me specifically or implicitly with an investment round or a board, I don't worry about it. I want to help entrepreneurs. I need to. It's how my business works, and I love doing it. So I'll take any call. The investing side can be a little more complicated with a personal investment vehicle only.
Mm-hmm. So Rob, there's a lot of talk these days about cost of capital, market uncertain. Is it a recession? Maybe it is, maybe it isn't, maybe it's somewhere in the middle. So I'm curious to get your view on the role of macroeconomic factors playing a shape in the investment strategies of the funds that and also for yourself. Could you unpack your view on the role of macroeconomics? Is it kind of like
Yeah.
there it goes.
Two broad-based categories, and this is a great topic, but two broad-based things that are vital to understand. One, for the last 10 years, 15, capital had no cost. People behaved as if it had no cost and built their business models and investing on it. Most of that, I don't know how much I'm allowed to express myself in my own natural language.
No, you can express yourself however you fucking want.
So here's a technical term. Most of that was bullshit, scam, or fraud. Okay. And so, but that's what happens when capital has no cost. It's not irrational in that way. Capital had no cost. Capital now has a cost. It's back on the calendar. It's back on the debate, right? Capital it always had a cost. We got to ignore it for so long. It seemed that you would create all sorts of things with, and we're seeing all that unwind right around us, whether it's Bird or WeWork or whatever the hell it is, right? There's just a lot of stuff that had to unwind. And the reason why that's relevant for startups is because those were the signal setters. I've been through cycles, right? And so the North Star becomes the company that makes up the most BS about their business, raises the most amount of money, and you're buried. You're trying to keep up with it, and you can never keep up with it unless you play that game, and it becomes dangerous in a lot of ways. So macroeconomically, yes, a massive, massive reset for startups. And the sooner you get over debating it, the better. Second macro thing is there are no bigger growth markets. There are no bigger nor more certain growth markets, short and long term, than climate and sustainability markets. None. If you can find markets bigger and more certain than climate and sustainability, go focus on them. But you can't. There are no markets bigger and more certain than climate sustainability focused markets. I would urge everybody to understand that that's where the money is, let alone the planetary need. The reason why the money's there is because of the planetary need. But so many things are coming together here to create enormous opportunity. I would encourage all entrepreneurial people to get that and get going.
Yeah, it's. I was chatting to a founder yesterday, Stan Smith. So he's raised a Series B, I believe, for circa 50 million or so. And he was also saying, it's from Gradient AI, and he was basically talking about when you analyze a market, like there's a lot of talk about pivoting, pivot to find your customer and so forth, but we don't actually spend, as founders, we don't actually spend enough time really looking at the markets. And so when you are standing in front of an investor or a VC firm and you're like, this is the market opportunity, it's just a number, but a little true due diligence happens on that industry. Like, okay, so you're saying it's renewable energy. Why is that in the context of the problem that you solve? Because it's not just renewable energy is worth that big. There's obviously sectors within the space, isn't there? And so the more you know about the problem, like the more you're going to be accredited with the solution, not only from the customer that's going to pay you the money to scale and hopefully, do what you want to do in terms of your vision, but also from an investor perspective. Like they also want to know that because if they know something you don't and you say that you know it better than anyone else, like that creates friction, and friction loses you the opportunity to raise.
Yeah, absolutely. So just two reflections on that. One of the most harmful concepts in all of venture capitalism is TAM, total addressable market. And the reason why it's harmful is because many focus on the T and the M. It's the A that matters, the addressable part, like addressable by you, when, in what time frame. The addressable part is the part that really matters. And that's what you unlocked in me. I often reflect on that. In climate and sustainability, from that macro question you asked to start, there's a fundamental shift now in that there's a false binary that has always plagued climate and sustainability growth opportunities. And the false binary has always been a simple question. Are you making money or are you saving the planet? It's a false binary today. The answer is yes. And when you find yourself forced into, are you doing this or doing that? I think you're missing where climate and sustainability is now. Way back when in Clean Tech 1.0, we had to make forecasted conjecture about the money-making part, about how the numbers would work. And that was a hard slog, and it turned out to be a worthy one, but it was difficult. Today, are you making money or saving the planet? The answer is yes. And then when it comes to market and addressable market, prove it. What are the metrics that are multilingual, that attach the thing you're doing for the planet and the thing that makes money? They need to be conversant with each other, and you need to own the numbers on both and translate them into your sense of an addressable market. And if you do that, you really are going to be welcome into a lot of great rooms.
Yeah, I mean, I was having this conversation the other day around what does it actually mean from it when you say TAM. It's not just the fact that there's 10,000 businesses that can buy your enterprise software for $1 million, and then 10,000 times a million makes you like the unicorn, right? It's actually about, it was an interesting reframe of what TAM means, and to your point around the A. So the A is about. It's defined by the number of businesses within that 10,000 that can search for and find your product. Exactly. Or that's in the market to buy the thing that you sell, because it's. Go ahead.
Yeah, sorry. I got excited. I didn't mean to cut you off, Matt. But the other part of the A, that, and then addressable by you. Like it's not a theoretical exercise. It's addressable in general. Now we're coming down to addressable. Is it addressable? And is it addressable by you? And you means the team. You means within the context of the roadmap of the opportunity and the money you're looking for. Why should I believe it's addressable by you? That's the powerful unlock we're all looking for, and is sometimes missed because it's easier to talk about total and market, and you can blow right past addressable because you can raise a lot of money with hand wavy, captivating conversation around total and market. And you assume you're talking about addressable at the same time because you got like a spreadsheet with showing some of it. But really great investors, they know how to dig in here hard, and really great entrepreneurs know how to build that really well. That's the magic in all of this, the addressable part.
Absolutely. And also, but these are the factors, right, that influence the investment decisions of VC firms, family office type investors, such as where you're at, and so on and so forth. Over and above TAM, are there any other factors that come to mind in terms of maybe risk or expected returns that you feel the world needs to know about, or that a founder needs to know about? Because to your point, it's like, yeah, it's $1 billion opportunity. Yes, but is it? Okay, cool. So we've landed all that stuff. You got to know all of it intimately. But what other factors there drive an investment decision from your perspective?
Yeah, I mean, I'm pausing because it's a big question. I think we all need to be humble to how hard all of this is. And yet there's a way to express your humility with charisma that makes the sale, sort of happen. So what do founders think? What do investors think? I don't think nobody good is looking for perfect, and nobody's good is looking for a 100% data-driven conclusion. Because if in fact you find a 100% data-driven conversation, it's too late for the startup. The data exists because it's been created by others. And so what's the blend of art and science, or gut and data? Everybody has their own rubric for that. Everybody has their own way of probing that. Everybody has their own screen. But in the end, all investors have to come up with their own blend of what works for them on gut and data and how that interplays. I think it's important for entrepreneurs to know what kind of investor they're dealing with. How does that investor express their needs for data versus judgment, or art and science? How do you as an entrepreneur think about those things? How much of the bridge to certainty can you build with data versus conjecture and your gut? I think being explicit about that can really help lead conversations. In the end, I've been in great investor rooms when an entrepreneur leaves, and I've seen arguments. I've seen arguments in that session live, and the entrepreneur leaves, and the venture people say, "Man, I loved him or her." They were so great. But the entrepreneur left going, oh, that was terrible. They didn't believe anything I said. And then I've been in rooms where it looks like everybody's nodding, yes, yes, yes. And the left go, what a passive person. They kept on believing everything I was asking. So, there's a nuance here about how that works in the room and out of the room that I've been a part of. My best advice is think hard about the art and science of the judgment you're trying to get someone to express. Know where you are and be explicit about it. I hope that's helpful, Matt. It's such a big topic. It's hard to do it in the abstract.
I get it. There's no way you can cover it all in one answer, dude.
Yeah.
That's why I'm going to write a book about it.
yeah, absolutely. Yeah, and I'm learning like everybody else, right? So I'm just one. The reason why I love doing this is it forces me to think about it more deeply than on my own. So I appreciate you asking me to be here today.
Yeah,
so I can learn too.
You're very welcome. You're very welcome, Rob. So I'm going to take a quick break, guys, and we'll be back. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. Rob, I'm curious to talk to you about, I touched on macroeconomics earlier, but, some of the key trends from your perspective that are shaping the VC landscape today. There was a tweet that I saw on what was actually a screen grab of a tweet by a guy who speaks to LPs all the time. And he was describing how LPs, limited partners, for those of you who don't know, these are the guys that put money into venture capital funds. They are disillusioned by a lot of the venture capital firms because they've gone and they've raised, like you had fund one for like 10 million and the second fund was like 10 times that. It was $100 million fund. And then with the macroeconomic stuff happening, they've been reluctant to actually, the venture capital people have been actually, reluctant to put the money into investments and because of the economy. And the LPs are going, listen, what are you guys doing? Like, we're a bit disillusioned and we're a bit upset, quite frankly, that's the case. So basically, he was making the point that some venture capital firms are mismanaging the LPs' total capital to invest. So that was just one context. But from your perspective, with the relationships rather that you have with your funds, what are some other trends that come to mind in terms of what's shaping the VC space right now?
Yeah, go back to first principles and trying to be useful to your audience. As I said at the start, there are a number of reasons why I created an investment vehicle that was focused on my capital only. One of them was to avoid any and all conversations with LPs and the universe of complexity there, because the venture business is completely distinct and apart from venture investing. Ideally, they're the same thing, but they're not. And the venture in business is complex. It has all these demands and artifacts that I know nothing about. I've never been good at. I'm honored when I'm asked to help and be an advisor or a fund member or a board member. But there's complexity to the venture business that we all need to acknowledge that I want to put there, and I'm not expert in. That said, LPs have always astounded me with the robust pace at which they like to write checks that have, over time, proven no ability to give them a better return than less risk through a low cost, vehicle in the public markets. And so, but the checks are there in private equity and venture LPs, and they're there for a lot of reasons. I think they're there because the best in class amongst those funds are worth it. It's kind of like in sports, Patrick Mahomes on the Kansas City Chiefs is worth his 10-year, $500 million contract. The problem is there's 10 other guys right behind him who say, well, Patrick's worth 50, I'm worth 45, when actually they're worth 10, but they're going to get paid that money. And anyway, so there's this weird clustering around comparables. and how that money drives. And so there's a whole infrastructure to that conversation. I just wanted to make clear. Yes, size of funds is exactly the kind of thing that is upsetting when capital has a cost and the returns are no longer flowing through the roulette wheel of chance and public market gamesmanship. And so this always comes up because what always happens is capital is inexpensive. There's a lot of movement. There's a lot of froth. You can raise more and more capital, and the 2% starts to drive you more than the 20, right? The fee is more important to you than the carry, no matter what you're saying. And in some cases, the management fee is so dynastic in its wealth creation for you that you'd kind of be crazy not to take it. So why do LPs keep on doing that? I have no idea, but they're cranky about it now. And there'll be a reshuffling of who gets to keep that capital and how they get to keep it. For the entrepreneurs out there raising money, I think it's really important to know the life cycle of the fund, where they are in their fund, what year they're in, to what kind of capital, what age and year they're in, because they are getting a lot of pressure from their LPs because LPs are resetting their own expectations now, and it's painful. Matt, was that responsive?
It was, man. It was great. Let's double click on that last point. Let's say you want to do a Series A for 5 million or 10 million, between 5 to 10 million, say. And you're looking at 10 VC funds and they're proven, reputational, equities high, and an end. In the life cycle of those 10 funds, what would you suggest, in terms of the life cycle of the fund, should you be looking at? Because I think, to your point, just another perspective to weigh in on there is that you can raise the 5 to 10 million and say 10 million from number one VC firm, number two, and 8, right? And it's still 10 million, but it's not the same. It's not the same type of capital. Does that make sense? Yeah. Because you're looking for more than just money. You're looking for expertise in a certain in a sector, or maybe you're looking for other things. So what if you were to hang your hats on a couple of things, what should they be looking for? Is it in terms of age of the fund or number of exits? Like, what other things should you be looking for as a founder over and above the number of capital that you're looking to raise? Yeah,
I love that. And just some structural comments first. I think the Series A raise is not in jeopardy today, other than your valuation expectations have to be normalized. But I think in Series A, that's easier to do. B, C, D rounds, there's a massive reset, and that creates its own set of structured topics. In terms of what a founder should look for from a firm, remember, I take this from the entrepreneur's point of view. I ran 3 companies. I got so hammered by the experience, I describe myself as being in recovery for 20 years. My name is Rob. I was a CEO. I'm much better now, right? This is an AA meeting for me with you, Matt, and others. So, but know that I keep that perspective in mind, because I think the most important thing to do is to know what the individual at the fund, not the fund, know what the individual at the fund that you're working with, that if they invest is your person. I would ask for references from them for CEOs and founders they've invested in when things didn't go well. I think that is a great moment, and it's a test of everything when it comes to a venture capitalist. How do you conduct yourself when things don't go well? Because most often they do not. And the source of friction and the source of tension and the source of loss is frustration with each other in difficult moments, when that's in fact when the real value added comes through. So number one, I would get the current list of who they work with that had some challenges and how they were in there. I think that's vital. In terms of where the fund is, some obvious stuff about making sure that you're in the cycle of the fund that isn't at the end of its life, because they won't be there necessarily for follow-on and other things. And that's always painful. Your Series A investor doesn't show up in the next round. It can be explained, but it can be difficult. I don't know that I have many views on the size of the fund or the size of the partnership. For me, I'm much more driven by the people involved and how they relate to each other and the chemistry of all that. It is vital that they sync as individuals. I've had all manner of people I've backed who I frustrated because of the way I behave, even with my best of intentions, or they frustrated me And I draw that down to the fact that we were just different kinds of people, and we didn't do a good enough job at the start understanding, here's how I like to learn. Here's how I like to communicate tough news. Here's how I think about metrics, just some core interpersonal things. I tend to focus my answer to your question, what should I look for on the individuals involved, and how committed you are to spend your time with them in the most mission critical ways possible. I focus there more than on the dynamics of the fund, if that makes sense.
It does. It's really great advice, actually. See, I learned something. That's why I do the show. I'm smarter now, guys. Better watch out.
Yay, me too. But I think founders are sometimes, depending on your experience level. I know this for sure. If you're an experienced founder, you know everything I just said, and you're sitting there going, oh man, is that true? I mean, I can't tell you how much I hated my life with him or her as my investor, even though the fund looked great. When you don't have that experience, you tend to assume you could fix it on the run. You can address an incompatibility on the run, and you can't. You never do, and it becomes the source of problems. Remember, I get invited onto boards, typically to be the independent outside person, typically to help do something an independent would do. And most of the time when it's not going well, it's because of these frictions. And that's how I ended up on the board to begin with, to somehow triangulate and get everybody to agree to define, align, and execute in the same ways. So I see this a lot in my business life. It gives me the opportunity for joining boards and investments if I can help address some of these topics.
Yeah, it's really, really key. Speaking of successes and failures, what would you say from an investment perspective, Rob, has been your biggest success and failure when making investments into startups, as an example? And what would you say has made the difference?
Well, the biggest difference has been being lucky. So how's that for non-value added truth? I mean, the role of luck in all of this is a hard one for everybody to contemplate, because it does put you into the realm of being somewhat fatalistic about things. But I think respecting the fact that luck plays a part is important. I think I have a lot of things that didn't go well. I tend to believe people and stay with situations way too long. I mean, years and years and years. And that's a limitation of me coming at this from the entrepreneur's point of view. I grew up in a family with a great entrepreneur. My father was a great entrepreneur, a Holocaust survivor who came to America and built a business, an old world business that I got to grow up in. So we're all constructed of raw material that helps inform us, and what we do with it is the asset or the liability. So an asset for me as an investor is my ability to connect to great people doing worthy things and helping them understand the roadmap to winning and being a part of that. My liability in that front is I never give up on it. I mean, you really have to take the ball away from me. And I look at investors who have much more discipline around that. And I wish I had that, because I've lost a lot of money, doubling down time and money on things that just had no A. They had all T, total and market, but the addressable part wasn't happening. And gosh, dang it, why didn't I see that earlier? But so, I mean, there's all sorts of other misfires I could name. Chasing returns, trying to be a market timer. There are people who are really good on the investment side of the moment. They have a sense of the zeitgeist. They know the kind of moment, the kind of investments that'll work at that moment in that time. I've never been good at that, and I'm so bad at it that when I try it, I especially lose money quickly. So that's not good. What works for me is caring as much or more about the opportunity as the founder does. And if I can do that, I found my way to create returns, great returns or little returns, but returns have come my way.
That's really cool, man. It's a really important point, that also, because I found you just want the money. That's kind of like 90% of guys. They're not going, well, does this investor or this firm care as much about this particular sector as I do? Like if you take the crypto space, for instance, that's a minefield. So do you care about the speculation or do you care about the technology? and those things are different. And so you really need to know who's on the other end of the check, because and what's actually motivating them. It's almost like I found like you need to interview the investor as much as they need to interview you, because you also have a choice. And if you feel like you're under pressure just to take the money because you need growth capital now, dude, like that's it. I've got to scale, and that's it because Silicon Valley says so.
No, absolutely. I mean, so it's absolutely true. You need to interview the investor, but the reality, of course, is the power relationship is just, not there. So it's hard. I mean, I don't want to pretend these things aren't hard, but because they're hard is why they're worthy to do, not why you shouldn't do them. But also, this issue of just the money or just the opportunity. For me, I don't get into opportunities unless I've been first invited to try to add value. And so for me, it's been strategically vital to add value to the entrepreneur or to the investor, or else no one cares about me or my money. Only I care. No one does. No one else does. And so I've had to build a dependency on knowing the things we're talking about, because it's how my business works. That said, I think you absolutely need to know how much your investor cares about what you care about. Now, if you both care about spinning some nonsense about tokens and you both are in sync on it and you both think the time is right, well, then go do that. And plenty of people have. My negative judgment is when there's a misfire about what you care about. And that is a bigger problem, right? The misfire. And so, yes, being explicit about what you care about and whether your investor cares about it is vital. And great investors are really good at that, really good at understanding you, how you think, how you operate, and whether it matches to how they think and how they operate. Sometimes they communicate that, sometimes they don't.
I suppose there's also the other side of the coin, isn't there? Where it's kind of like, do your 10 LPs also care about climate change as much as you do managing their money? Because there may be a disconnect there too. Yeah.
And so venture capitalists who are entrepreneurs running startups called venture firms have, shareholders. And so they have, a similar dynamic. However, they've been really expert at telling their stakeholders to shut up and leave them alone. They become really good at it, right? And just send me the checks and just sit in the corner and I'll talk to you once a year. And because they've shown an ability to raise money as an industry, shown an ability to raise massive amounts of money through bad returns. So, until the checks stop, VCs won't change because no one else will either. I started this by saying I don't understand LPs. Here I am again. I don't understand LPs, but so it's not quite equivalent to what a VC faces with their LPs, unless it's a great VC with great LPs. And I can guarantee you, great VCs with great LPs are in fact structuring their relationship on the basis of their priorities strategically, financially, culturally. The great ones do that, but the great ones in anything are rare. And so you really got to understand, who you're dealing with.
Yeah, absolutely. What's one piece of advice, Rob, you would give to a startup or a founder, him or her, looking to raise capital? What would you hang your hat on? There's a lot of things to consider there. Big question, I know. But if you were to, gun to your head, choose something, what's that one piece of advice?
Oh, wow. I guess my biggest advice, my most useful advice I could offer to that question quickly would be to really cultivate an earned self-confidence when it comes to how you react to feedback. Because raising money, you'll get a billion sets of feedback. And it'll be mostly well-intentioned and smart. But the problem then becomes you end up chasing everybody's feedback, and then you end up becoming a mile wide and an inch deep in the areas that are really most impactful, because at the end of the day, your earned self-confidence needs to draw a line and say, you know what, Matt said a lot of things. I know he's earnest. I know he's smart, but I think he's wrong. Is that your ego speaking, or is that your earned self-confidence speaking? It's just It's a hard thing to get right. And so I would ask all entrepreneurs to be specific about how they earn their self-confidence and know that about themselves so they can structure their way through the asking and the feedback that's so exhausting successfully, because they will get a million no's. Those no's will hurt. And it's only an earned self-confidence that tells you what to do with the no's, how to learn from them or ignore them. And so maybe that sounds a little too loose or hard to measure, but the one piece of advice I have is understand your earned self-confidence and where it comes from, because it's the thing that will sustain you, and it's the thing that will attract the right investors for you to you.
That's a really great piece of advice, that. I'm a big believer in the fact that this whole world of business is as much internal as it is external, and the entire conversation is well, I say most of it is based on this external world. Structuring safe notes, and what's the best capital structure, and who's in my cap table, and it's like, okay, dude, but like you matter in that. You know what I mean? And so you have to make or do you raise it all?
Yeah, no, absolutely. Very, very much so. And I think going back to the art and science conversation or data and judgment, I think the obligation for all of us, entrepreneur, investor, is to be intentional and specific about how much of our judgment in any particular case is driven, how much of the pie, how much of the equation comes from data and how much comes from judgment. And it can be 99 to 1 and 1 to 99, right? But being explicit about it is vital. I'm as data driven as anybody else. I'm known in my own universe as being very impact focused, and I'm impact focused because I need not just the words, but I need the impact numbers. And I have this whole conversation about the abuse of KPIs and OKRs and impact and all that. Okay, but when I make my own self crazy, which I do, about data, and I confuse myself, which I do, about data, I take guidance from E. Cummings, the great poet. And I'm not going to say this well, but he's got a great poem called Lips to Lips or something. And there's an element of that poem which I often think of, which is something like, as long as you and I have lips that are for singing and kissing with, who cares if some one-eyed son of a bitch invents an instrument to measure spring with? So I butchered it. I prefer to get you to E. Cummings, but data drives us a long way, and it should. Be intentional about it. But at the end, step back and understand what matters is we have lips that are for singing and kissing with, right? And I don't care if somebody measures what that means, right? It's an internal clock that drives some of this around judgment. Be intentional about how much is coming from what source, and I think you'll be very successful as an entrepreneur or an investor. So how's that? Now I'm giving your audience E. Cummings. They'll never listen to you again.
Yeah, no, they're done. Crickets out there. It's crickets.
They're out.
Ribbit. That's awesome, man. So quickly, just on exits. As an investor, how do you evaluate and prioritize an exit? So let's say you put, I don't know, 5 million into a startup, whatever the case is. And they're, and you're now going, well, return on capital. I have this LP these LPs they're jumping up and down to my point prior. So what goes into your strategy around prioritizing, evaluating exits when you make a private placement investment?
Yeah. And so again, to be useful to your audience, I just want to reiterate, like everybody should, what works for me because of how I'm constructed as an investor, so that anybody who listens to this can ignore it or embrace it, but they know where it's coming from. And so one of the things I thought would be an advantage for an individual investor as my own LP is that I'm not wed to timeframes of exit. And if you can, there's a downside to riding things out over a long period of time, as we talked about before. But there are also opportunities that come from being, from staying with something that, you can be surprised when others got frustrated. If you stay with it, the returns come. So as an individual investor, I don't have the LP time to money IRR clock driving me. That can be both an asset and a liability for me at Treehouse. I acknowledge that. So I want to make sure I offer that here. In terms of structuring a conversation around exits and what matters to investors, a good portion of the investors need only the return exit ratio required to raise the next fund. That's not necessarily a bad thing, but if that's the kind of investor you're dealing with, you need to know that. And it's relatively easy to understand that's who they are. And then that gets you to the life cycle of the fund, where have their prior exits been, what level, and then you can find out if there's a fit or not. The best investors I know think about, cash on cash, and they think about time value of money, not because of how they think the LP thinks about it, but because they understand how an investor thinks about cost of capital, risk to that capital, and time. So I'm giving you a lot of buzzwords here. I apologize for that, but the exit scenario is let me reframe. The question you asked about exits for an entrepreneur in a venture firm has judgment to it and has data to it and has a lot of different ways to getting at good results. If you're going to invest in something, particularly a startup, you need to make sure you as a founder and you as the investor have the same formula in mind. And so the great question is, well, what do you think is a good return for this? Here's the capital I'm asking for. What do you investors think is a good return? And if they give you, a billion X, then factor that in. If they give you something that you think is achievable within the span of your opportunity, then do that. But I think it's a great conversation to turn from the abstract level of exits to the specific exchange of investor and entrepreneur discussing with each other how they want to get there. Something I hate personally is when a founder gives me a forecast of returns. I hate that. Other people love it, so who knows? But I hate it when I got a founder telling me, here's what I think you'll make on your money. It shows me the wrong kind of thinking personally by a founder. They're thinking exit and managing those things when they really are outcomes of other activities. They're not anything you can direct. But I think it's a great conversation for a founder to turn around and demand of the investor. How do you see returns? How do you see returns for this? How do you see returns from the kind of thing I'm doing fit within the flow of what you're looking to do? I think it's a great conversation to arrive at together.
It's a really great question, Nat. What return do you feel is appropriate for this investment with me? I think that's a really amazing insight.
Yeah, make it personal that way. It'll help everybody.
Mm. So let's see. So a couple questions and then we'll wrap up. What keeps you up at night about the world of venture capital these days?
I don't spend a lot of time thinking about the world of venture capital. So I guess I would say nothing. But I've structured my life to be away from all that. And I've had the good fortune to be connected to some great venture capitalists, either formally or informally, on boards and different things. And so I've gotten the great benefit of structured, thoughtful people in times of trouble and how they've handled situations and clients. So I tend not to worry that much about venture capital. I worry about LPs, and I worry about LPs and the rate at which they write checks into categories of investment that are going to harm their constituents. They manage, they're LPs for a reason, right? And so forget about someone like me. I mean, pension assets and, there's this huge societal dependency on the capital decisions they make. And I worry about LPs. I worry about them a lot. And I've always worried about them. And I worry about the pretend assumption rates they've built into some of their models that drive them to putting more capital at risk because the model requires more return. And so a category promises more return. So the math works out. But on the ground, this assumption of return, no one is hit. And anyway, so I worry about LPs more than I worry about venture capitalists. Venture capitalists are going to take their fees over their 10 years and do just fine. And then likely, even if their returns are horseshit, they'll raise more money and they'll do fine. Or they'll be out of business, but they bought the house in Maui and they'll be fine. Of all the people in this equation, I think the least about VCs. I think the most about founders and LPs and things that keep me up at night on their behalf.
Awesome, man. This space of venture capital is evolving. Crowdfunding wasn't as big as it is today, and it just seems to be a space that's continuously in flux. What would you, or how do you see rather the role of venture capital evolving in the future, and what would you say would be its impact on startups or founders looking to raise capital?
That's a great question, way above my pay grade to answer well. I think if we talk about venture capital and the future, to me, I think venture capitalists who design structured opportunities to attack impact are the most worthy of backing. I mentioned Backstage Capital before. I mean, there are a lot. Because I'm an investor in it, I don't want to make this or that of it. But Arlen Hamilton has been brilliant from the beginning in articulating why investing in underrepresented founders is going to create an enormous financial opportunity for investors. And it's a hard road to go, and there are a lot of brilliant investors doing just that. And Arlen would be the first to tell you that too, and all that. I've had other investors who've taught me great things about seeing opportunities uniquely. I was an advisory partner at Oak. They did some brilliant things in social media early that I learned a lot from and benefited from. But they were brilliant at it because all these investors are brilliant at what they do because they, to me, or hedge funds that I know that do what they do, and on and on. And now in climate and sustainability, all these investors are brilliant to me because they think about impact, and they know that impact has multi dimensions that need to be interwoven: financial impact, personal impact, reputational impact, customer impact, social impact, planetary impact. Right? And the great ones see no daylight between any of those topics. They're orchestra conductors who have this massive orchestra of musicians, and for you and I, we stand there and it's just this holy mess of sound and it's confusing. But the great ones conduct all that so magnificently that it sounds like a symphony, and they bring it together on time and on pace. So I think it comes from impact, and I think those investors who are driven that way will be successful going forward, no matter what LPs are thinking, no matter what the economic environment is, because that's unique, that's valuable. It drives the economy forward. It drives entrepreneurship forward. It attracts the best entrepreneurs who are built that way. I don't know. So Matt, it's a great question. But for me going forward, impact-focused venture capitalists who are great orchestra conductors with all these things in mind, they're the real winners, and they're the ones that entrepreneurs should find and seek out.
Couldn't agree with you more, Rob. Let's wrap this up. I'm going to give you the keys to the Matt Brown Show time machine, and I'd love for you to go back to yourself on day one when you were like, hey, I'm going to get into the investing space and private placement space. What advice would you give yourself about investing in startups on day one?
Great. So this is like the therapy session. Well, let's see. Number one, I do well when I talk about making sure I understand myself as an individual and how I think, how I score, all the things we talked about that you have to make specific. However, there are definitely times where I've thought about myself so completely, I missed waves of opportunity that were there within my bailiwick to go grab. But because I was so focused on some of the things we talked about here, I over-focused on my box and how I see things, that, I picked up a win or two here, but I missed massive waves where things that were close were also winners, because the moment, the vintage of that year, the timing of the opportunity, the coalescence of factors, had I been more observant away from myself, I would have created more meaningful returns. But I I didn't trust that about myself. I started very narrowly and it kind of worked, but I wish I'd been more expansive at the start in terms of taking a beat and looking away from my box. On the one hand, you can only do what you can do. You can only know what you can know. You got to know your pitch. All that is true. But the investor part requires you to get outside of your own head better and more meaningfully than I did, and than I have, and I wish I had known that then, and I'm learning it now. I guess the second thing I would tell myself then is to trust my instincts about people even more than I did. Just trust it, because if there wasn't a match and it felt wrong, you know what? I was right. Not because the other person was the problem in this scenario, right? It was because there just wasn't a fit. I should just have. I mean, I think our gut instincts about who we connect with, I think they're there. I think we should trust them. And I would tell myself to go ahead and trust that even more.
Intelligent intuition. That's what I call it. And you should absolutely trust that. Rob, thank you so much for being on the show, bud. I think your perspectives are unique, and I really am privileged to have had you on the show, man. Thank you for supporting it. Thanks, everyone, for tuning in as always, and we will see you all again soon. Cheers.